Golden parachute payments have long been a topic of debate in corporate America. These payments, made to executives during changes in company control, are regulated by Section 280G of the Internal Revenue Code. Today, we'll explore what these payments are, how they're regulated, and why they matter. Golden parachute payments are benefits given to certain executives or key employees when a company undergoes a change in control. These can include severance pay, bonuses, accelerated vesting of stock options, and continued benefits. Section 280G was created to protect shareholder interests by preventing excessive payments during corporate transitions. So, how does Section 280G work? It applies to both public and private corporations, but not to S corporations or partnerships. The rule kicks in when payments equal or exceed 3 times the average annual taxable compensation an individual received over the previous 5 years. This baseline is called the base amount. Who exactly is affected by this regulation? The Internal Revenue Service defines disqualified individuals as corporate officers, shareholders, and highly compensated individuals. This typically includes those earning at least $115,000 annually and falling within the top 1% of employees or the top 250 highest paid employees. A change in control, which triggers these regulations, can occur in several ways. It might involve acquiring 50% or more of a corporation's fair market value or voting power. Alternatively, it could be when an individual or group gains 20% or more voting power within a 12-month period, effectively controlling operations. Even a majority change in the board of directors within a year can constitute a change in control. Now, let's look at some examples of parachute payments. These can include severance pay, cash bonuses, continued benefits, accelerated vesting of compensation, retention payments, and stock options. However, not all payments are considered parachute payments. Reasonable post-termination payments, non-compete agreements, and certain retirement benefits like 403A annuities are excluded. What happens when payments exceed the threshold? The consequences are twofold. First, the individual receiving the payment faces a 20% excise tax on top of regular income tax. Second, the corporation loses its ability to deduct these payments for tax purposes. This double penalty aims to discourage excessive payouts. There are some exceptions to Section 280G. For instance, payments approved by at least 75% of disinterested shareholders in a private corporation can be exempt. This exception requires full disclosure of payment details to voting shareholders. Why is all this important? Section 280G promotes responsible corporate governance by aligning executive compensation with shareholder interests. It encourages transparency and accountability, which can enhance a company's reputation. By discouraging disproportionate payments, it helps preserve corporate value during ownership changes. Understanding Section 280G is crucial for executives, board members, and shareholders alike. It shapes how companies structure compensation packages and approach corporate transitions. As the business landscape continues to evolve, so too will the discussions around golden parachute payments and their regulation.